corporate actions. Now the agenda for this session would be like, what is corporate actions, examples of corporate actions, and the different types of corporate actions. So first one, what is corporate actions? So corporate action refers to any action taken by the board of directors that brings either material change. Now, what do you mean by material change? In the sense, like any action taken by the board of directors that that brings changes in the price of the share. So change in the share price. So because of their decision, share price gets changed. Then in that case, it is a corporate action. Or any structural change. Structural changes in the price doesn't get impacted. However, the structure of the company gets changed. Say for example, like name change, a company's name is getting changed. So even that can be considered as a corporate actions. Okay, so that's what is corporate actions. Now examples of corporate actions: cash dividends, stock split, reverse stock split, bonus issues, spin-off, merger and acquisitions, rights issues, buyback. These are some of the examples of corporate actions. We will see one by one. So number one, cash dividend. That's a very simple one. Cash given back to the investors is technically called as dividends. So company has made profit, and so they are giving these profits in the form of dividends to the investors. This is cash dividend. Then the next one is stock split. Now stock split, as the name says, stock is being split. One stock is being split into multiple. Say for example, you have one stock and the price of the stock is 10,000 rupees. So I'll just write and show it to you here. So you have one stock and its price is 10,000 rupees. Now when its price is 10,000 rupees, the problem that this stock is going to face in the market is liquidity. Technically it is called liquidity issues. So liquidity issues means it will be difficult to trade with a share of this high amount. Okay, so if somebody wants to sell, they will not be able to sell it easily, and at the same time if somebody wants to buy, they will not be able to buy it easily because it requires like 10,000 rupees. So if I have 1,000 rupees in my hand, I cannot buy this particular stock. So this is bringing in liquidity issues in the market. So in order to sort out these issues, stock split is introduced. So stock split, in this stock split, one share is split into multiple. Say for example, one stock over here, 10:1. So one will be divided into 10 stocks. If one is divided into 10 stocks, mind you, the end amount remains the same. So initially also, let's say client had one stock and the total price of the stock was, the price of one stock was 10,000, and so the total value was 10,000 rupees. So even after the stock split, he will have 10,000 only. Okay, so it's not that he is getting some extra amount, but the support that he gets over here is, now instead of one stock, he will have 10 stocks. He will have 10 stocks, and accordingly the price per share will also come down. So the price per share will come down to 1,000. So that 10 into 1,000, again it will come to 10,000 rupees. So at the end, initially also client had 10,000 rupees, even now he has 10,000 rupees. The only thing is, earlier he had one stock worth for 10,000. Now he has 10 stocks of 1,000 rupees each. 1,000 rupees each. Okay, so this is called stock split. Splitting stocks into multiple shares in order to bring in liquidity into the market. So the only purpose is to bring liquidity into the market. This is called stock split. So which I have mentioned it over here in words. Okay. Now moving to the next one, reverse stock split. Reverse stock split is just the vice versa of what I was discussing now. So the first one, the problem is liquidity issues and the stock has become too expensive. One stock 10,000. But imagine if your stock becomes penny stock. Let's say one stock is, let's say 1 rupee. So if one stock is 1 rupee, imagine 10 stocks are there. Okay, so in your portfolio you have portfolio worth for 10 rupees, but the stock price is, one stock's price is 1 rupee. Now the company is worried that when the price is 1 rupee now, tomorrow, if recession happens or anything, any war or anything happens across the world, quite possible that, the company can come down to, company stock price can come down to zero and it can be delisted from the stock exchange, or it will become worthless in the market. So in order to, tackle this issue, what the company can think is they can go for reverse stock split. Reverse stock split. Now what happens under reverse stock split is multiple shares will be clubbed together. So now here, let's say one share is 1 rupee. Now they will say like 1:10, for example. So when I say 1:10, 10 stocks are clubbed into one share. 10 stocks are clubbed into one stock. So initially one stock you had, or initially 10 stock you had, 10 rupees. Now you will have only one stock. So initially you had 10 stocks. Okay. Initially you had 10 stocks, but price of one stock was 1 rupee. Price of one stock was 1 rupee. So 10 stocks you had, which is 10 rupees. Now you will have only one stock and its worth will be 10 rupees. Okay. So 10 stock has been clubbed to one stock. 10 stock has been clubbed to one stock. So you will have one stock for 10 rupees. Okay. One stock for 10 rupees. Right. This is called reverse stock split. Reverse stock split. So instead of splitting, you are clubbing multiple stocks together. 10 stocks has been clubbed into one stocks. Okay. And accordingly, the price also will go up proportionately. So initially it was 1 rupee. Now one stock was one rupee. Now one stock is 10 rupees. That is reverse stock split. Then the next one is bonus issues. Now bonus issues is also very similar to stock split. So in stock split, in stock split, as I said, like stock is split into multiple parts. Similarly, over here in bonus, imagine you have, let's say, one share. Okay, you have one share and its worth is 10,000 rupees, and so total value is 10,000. However, now the company will declare bonus something like 10:1. So if you are having one share, it will be converted into 10 shares. So you will have 10 shares, but however the net worth will still remain the same. Okay, so 10,000 rupees. Over here also 10,000 rupees. The difference is, again, accordingly the price will come down proportionately here. The difference is in terms of the difference is very similar to stock split. However, the difference is in terms of the purpose is not only to bring in liquidity. Liquidity can be one of the reason. However, the bigger reason is to capitalize the reserves. To capitalize the reserves. So company will have some reserves and surplus, and they don't want to pay out just as dividend. Company wants to utilize that reserves in the form of capital. So after giving this bonus, it is as good as they have given 9 shares freely to the investors. But whatever be the value of those 9 shares, that will be converted, that will be taken from reserves. So accounting point of view, it will be reserves and surplus account debit to bonus issues. Okay, so this amount will be taken from reserves and surplus, and then a bonus issues will be issued to the investors. This is the accounting entry. So the purpose is to capitalize the reserves. Okay. So it will send you a positive signal to the market that the company is serious about the expansion of the company. The company is growing. In the long run, the share price can go up further. So that's the signal that the company is giving to the investors by issuing bonus shares. Right, and here the face value also will not change. Face value will remain the same for the share, whereas in stock split, face value will come down proportionately. Right, so this is the difference between stock split and bonus. Otherwise, this effect is the same between stock split and bonus. Okay, number of shares and the price per share, the way it changes, it remains the same. The difference is in terms of the face value and capitalization of reserves. These are the differences which I have articulated over here. Bonus. Next one is spin-off. Now what happens is, in spin-off, imagine a company working in two different sectors. For example, India Cement is doing cement business, as well as they are owning Chennai Super Kings cricket team. So now these two are different segments, right? So imagine in this case, these are owned by the same company, India Cement. Now imagine this Chennai Super King, grew so much that it needed special focus, separate focus to grow further. So in that case, quite possible that it can be separated from the parent company. Which is the parent company? India Cement is the parent company. So from the parent, a subsidiary is separated from the parent company and it is given the status of a new company altogether. So it will have a new board of directors who will manage this company, so that this company gets the required focus for further expansion. So in such case, it is called a spin-off. Spin-off means it has grown up so big that now it is coming out of its parents' home to set up its own home, or to set up its own new business, new company. Okay, that is spin-off. Next one, merger and acquisitions. Now, merger and acquisition. Merger means two companies of equal caliber comes together and they get merged, and the intention could be to beat the competition, or to synergize the positive points or the strengths that each other possess, utilize each other's strength, and then beat the competition. So that is the purpose of merger. Acquisition, there is a thin line. Acquiring means one company acquires another company. Here the intention can be just to control the business, and when one company acquires another company, it can be completely in different business also. That is also possible. Like for example, L&T infrastructure company is acquiring L&T, imagine some IT company. So here both are completely different. So this can be done to diversify and to control other business. Okay. Next one is rights issue. So rights issue means it is the right given to the existing shareholders of the company to buy additional shares at a discounted price. Now, why at a discounted price? Because if it is not given at a discounted price, investors will never be interested to buy additional shares. So certain ratios will be specified over here. Like if you are having 5 shares, you can have one more share. That is the right given to you. So 1 share for every 5 share, 2 share for every 5 shares. This kind of ratios will be specified, and accordingly investors can buy these additional shares at a discounted price from the issuer. Right? That is rights issues. Then the next one is buyback. Now what happens in buyback is, company buys back the existing shares. Okay, it can buy back the shares from the existing shareholders. Now why do they do this? Initially they are issuing shares in an IPO, right? Now similarly, after some years, if company wants, they can buy back the issued shares also from the investors. Why would they do this? There can be multiple reasons. One is they have enough cash and which they don't want to pay out as dividends, and so they will buy back it. Why they don't want to pay back as dividends? Because they will have to pay heavy tax in the form of when they pay out dividend, they will have to pay tax to the government. So in order to avoid this, they want to buy back shares. This can be one reason. Another reason could be like company is matured enough, and so they are not planning to grow further. So when they are not planning to grow further, let's reduce the number of shares in the market, so that when they buy back, the number of shares in the market will get reduced, and when the number of shares in the market gets reduced, the earning per share will go up, because earning per share, the formula is what? Earnings. That means net profit. So earnings is net profit or net income divided by earnings, earning per share, right? So net profit divided by number of shares, total number of shares outstanding. So total number of shares. So when total number of shares is coming down, because they will buy back and they will reduce this total number of shares. So when this gets reduced, so earning per share will increase. So imagine earlier, they were distributing it to something like 10 lakh investors. Now they are distributing it to 9 lakh investors. So automatically when the denominator is coming down, numerator goes up, and so earning per share will go up, which is good for the existing shareholders of the company. This can be a reason. Or imagine during recession, when the share price of the company is highly down, company can capitalize such circumstances by buying back, and it is giving a signal to the market that its share price is undervalued and it is ready to buy back these shares at a premium price. So typically it is bought back at a premium, because only then investors would be interested in it. This is buyback. Now, if you want to see the corporate action online, there are many ways. One of the ways, you can simply go to moneycontrol.com. So moneycontrol.com. Once you go to moneycontrol.com, do Control F. Type corporate action, and you will go to corporate action section. Click on this see more board meetings. So you will see all the corporate actions here, like bonus. Click here, you will get to see all bonus. So these are the companies which has issued bonus now. Okay, these are the companies and the ratio at which they have issued bonus. Then splits. Split is stock split. Stock split, as I said, in stock split, the face value gets changed. That is mentioned here. Rights issues. The next one is rights issue. So like this, you can check out the corporate actions here. All right. The next one is, so we have seen all the examples. Now the next one is, how do we categorize all these examples? This can be categorized into two types: mandatory corporate actions and voluntary corporate actions. Now under mandatory corporate actions, cash dividend, bonus, stock split, reverse stock split, spin-off are the examples of mandatory corporate actions. Now what do you mean by mandatory? Mandatory means irrespective of whether the investors like it or not, whether the shareholders like it or not, these will be, this will be happening, it will be executed. So, voting happened, and imagine voting happened, board of directors decided that, they will pay this cash dividend. Now, even if you don't like, it will hit in your account, this dividend will be paid out to you. That's why it is mandatory. Mandatorily, investors, it will be reflecting in the accounts of the investors mandatorily. Bonus issues. So, even if the investor doesn't like, once it is decided by the board of directors, bonus will be issued to the investors. Similarly, for all other examples also. So this will mandatorily reflect in the shareholders account. Voluntary corporate actions. It is an option given to the investors whether they are interested in it or not. If they are not interested, they can leave it. For example, rights issue. So if I am not interested in buying additional shares at the discounted price, if I am not interested, I can just leave it. So this is voluntary corporate actions. Similarly, buyback. If I am not interested in surrendering my shares to the company, I can leave it. Similarly, tender offer. Where imagine some other company is giving an offer. Tender offer, buyback offer. In buyback offer, the company itself is giving an offer to buy back the existing shares. In tender offer, other company is giving the option. This is basically to acquire the company. Other company is giving an option. I am owning shares of X company, and Y company is giving an offer to the investors to surrender their shares to Y company. Why would Y company do this? In order to control company X. So in such case, it is the tender offer. It is up to the investor. It is up to me whether to surrender my shares to company Y or not. This is tender offer, right? So these are some of the corporate actions and its types. There is one more as mandatory with choice corporate action, where there is only one example, that is cash or dividend corporate action. I have not included in this because that's very theoretical and very rarely happening one. Okay, all right. Otherwise, this is the one. Thank you so much for your patience. Thanks a lot.